Fidelity Contrafund is one of the largest, oldest, and most successful mutual funds of all time. It's dominated the S&P 500 for over half a century, generating almost 20 times more wealth. So today, I'm going to professionally analyze it with my three-step process for evaluating active funds. How did they do? How did they do it? And most importantly, can they do it again? Before we dive in, a quick word on my process. This will be extraordinarily valuable if you want to learn how to evaluate funds yourself like a professional. But feel free to skip ahead 2 minutes to the next chapter if you just want to get right into the details of Fidelity Contrafund. I've been evaluating funds professionally for almost 2 decades. And the main reason I developed this process is because just looking at past results, which is what most people do, even financial advisors, simply doesn't work. It's not that you shouldn't care what a fund has done in the past. It's just that by itself, that really doesn't tell you much. Just looking at the results alone is like saying the team won 17 games this year. Is that good? Well, maybe, but we need more context. If it's an NFL football team, they went undefeated, best season ever. If it's a Major League Baseball team, that would mean they went 17 and 145, worst season ever. With funds, step one is looking at how a fund did. But step two is the context. How did they do it? Let's imagine it's a really aggressive fund, and we just had an amazing run in the stock market. Well, a really aggressive fund should do well in that environment. But if the market is really expensive after a strong run, is that the time to invest in a really aggressive fund? Probably not, because they'd also be likely to do really badly in a downturn, which would then be a lot more likely to happen soon after a strong run in the stock market. The opposite is also true. If a fund did badly, but its approach was simply out of favor, then that's not necessarily a reason not to own it. So, what we're looking for in the how did they do it section is what were the elements that led to their success or lack thereof. And the third section, can they do it again, is the most important because you can't buy past results. This is the key thing that most people miss that causes them to honestly kind of suck at picking funds. Many factors influence the success of a mutual fund: who is managing it, the investment process, the market environment, the expenses, and some factors are reputable, but others are not. Differentiating between those can make a huge difference in boosting your odds of picking future winners, which of course is all that matters because, again, you cannot buy past results. Now that you understand the process, let's apply it to Fidelity Contrafund. We already saw that since its inception in 1967, it's generated nearly 20 times the return of the S&P 500. Calling that extraordinary would probably be an understatement, honestly. It's also done well recently. Not only has it beaten the S&P 500 over the past 1, 3, 5, and 10 years, but it's also beaten the average growth-oriented peer in the Morningstar Large Growth category. You can see a little bit of what I was talking about earlier here. Over the last 1, 3, and 10-year periods, growth-style funds, like the ones that own more tech, have generally beaten the S&P 500. So that tells you two things. One, if you're evaluating a growth-oriented fund, just simply saying that it's beaten the S&P 500 doesn't really tell you if it did well or not. Most of them have beaten it. It also tells you that since markets are cyclical, this kind of fund has been in favor for a pretty long time, and that could be an indication that they aren't less likely to be in favor for the following 10 years. Typically, that's what would happen. Though, if you're a big believer in the Mag 7 and AI, maybe you'd think this time could be different. That's a topic for another video, though. The main point here is that Fidelity Contrafund didn't just do well because it's a growth fund. It did well versus other growth funds too. And it even beat the S&P 500 over the last 5 years when growth funds were out of favor and mostly trailed the S&P 500. Okay, following me? So how did the fund do? That's the easy part. Now for step two, how did they do it? This step can also help determine if a fund is right for you. Maybe a fund did well because it's aggressive, but you're a conservative investor. Or maybe it did well because it has a lot of tech, but you work for a tech company and you have a lot of company stock, so you want to own less tech in your investment portfolio to avoid doubling the risk. Whatever the reason, understanding how a fund is managed can not only help you evaluate its odds of success in the future relative to its benchmark, but also how well it would fit within your portfolio and objectives. So Let's start here. How is it invested? To find this, we're on the free version of Morningstar.com. You can type in any fund or ticker to pull up this page for it. And I just clicked on the portfolio tab that you can see with the little blue underline toward the top right to get there. On the left, basically nothing out of the ordinary to see here. What I'd be looking for is something that I wouldn't expect to see in a US stock fund, and that would warrant further investigation. But in this case, it's pretty plain vanilla. On the right, we can see that while it's a growth fund by category, it's actually less growth oriented than a typical growth fund. We can see that by looking at the little blue dot. The typical growth fund is in yellow. The big blue oval is showing where all its holdings are, and you can see that it's a pretty broad range. There are a few other views here that I won't dive into, but the main thing that I'm seeing here is that it's not really a pure growth fund like, say, the Russell 1000 Growth Index. It's more diversified and more of a replacement candidate for an S&P 500 index or ETF, maybe somewhere between broad like the S&P or growth-oriented like a growth ETF. If we scroll down, we can see its factor profile over the last 5 years and a bunch of valuation metrics. Factors are like characteristics of an investment. So we can see it's generally growth-oriented with a low yield, high-quality companies, etc. Its momentum is high right now, but with the lighter shaded area, we can see that that has actually shifted around a lot over the last 5 years, whereas quality really hasn't. This kind of view gives us a sense of how the portfolio is managed and in what ways it may or may not change in the future. It's probably not going to be buying much of low quality, unprofitable companies anytime soon, nor is it likely to invest in a bunch of small caps. Actually, on the last one, it really can't since it's over $170 billion of assets, and in order to own a lot of small caps, it would need to hold like 2,000 companies. On things like momentum and style, though, it looks like the management team is a little bit more flexible. Of course, you can look at many other things like sector weight to regions if you're considering a global or international fund, and many other things, many things. But let's move on to the things that I think are more consequential specifically for Fidelity Contrafund. First, it's individual holdings. This is the first thing I'd see that would personally concern me. For you, this might be a positive, but having over 17% in any one company would make me, personally, a little bit nervous. This is nothing against Meta, it's just that this feels like a lot of concentration in one particular company to me. The flip side of the argument is, well, if you just trust the portfolio manager or portfolio managers, don't you want them to invest heavily in their highest conviction ideas? Yes, in theory, but it comes down to personal preference. This is simply a high risk, high reward strategy. It's likely to be more boom or bust depending on the fate of Meta and more broadly the Mag 7, at least the way it's currently positioned. Some people like that, others don't. I don't think it's universally good or bad, but for me personally, this kind of concentration just makes me a little bit uncomfortable. Then again, the track record is amazing, so let's continue. Here is the second thing that concerns me with Contrafund. And this is really the first thing I'd look at in stage 2 of evaluating an active fund. How did it do it? Because it can stop you from wasting your time on looking at anything else. But since I already looked at it and I knew we were not wasting our time, I wanted to show you the other stuff first. The number one most important, reputable driver of active success is the management team. If the management team was replaced yesterday, then the entire past track record is meaningless in my opinion, and I pretty much will not consider investing in that fund. Now, I've known this fund for a long time, and for almost 35 years, it's been managed by one man, Will Danoff. A significant amount of its long-term excess return has been driven by him. He is the main reason Fidelity Contrafund has done so well. Nothing else about it is unique. If he leaves, that could be very concerning because very few people can do what he has done. We all know most active managers can't consistently beat the market, right? Well, he obviously can, and we've seen this story many times before. A lot of people know the Fidelity Magellan story with Peter Lynch. It did extraordinarily well in his tenure of about 13 years. Then the next 13 years after he left, still good, but definitely not what investors were used to. Definitely not what they were expecting. A more recent example is Virtus Emerging Markets. It was managed by a legendary portfolio manager named Rajiv Jain from 2006 to 2016, and it was dominating the MSCI Emerging Markets, which I use the ETF M as a proxy for. Since he left, the new managers gave up the entire lead and then some. Not good. This is what concerns me about Fidelity Contrafund. Yes, Will Danoff is still there, but according to Wikipedia, he was born in 1959. That would put him at around 65 or 66 years old. Could he manage into his 80s? Yeah, he could. But if he was going to do that, then why did they name two more portfolio managers to Contrafund for the first time this year? They're only going to initially manage 10% of the fund, so they won't have much of an impact on its results for now. But this feels a lot like succession planning. I haven't seen any announcements of his retirement, but I wouldn't at all be surprised to see him retire in the next couple of years. If he did, I would be pretty concerned, unless the new portfolio managers, which presumably would be Asher and Jason, also had really good track records on US stock funds. So that's what we'll look at next. But before we get there, one more thing that really stands out to me is that 71% of you who watch this channel regularly haven't yet subscribed to it. So could I ask you for a favor before we continue? If you like this channel, you're getting value out of it, and you want to support us, the free and easy way to do that, it would have a massive impact on our lives and cost you nothing, is by simply hitting the subscribe button. And my commitment to you is that if you do that, my partner Cal and I will do everything in our power to help you improve your life by becoming a better investor. Thank you so much. All right, let's see if we can find anything else out about Asher and Jason's track records. Asher has been a portfolio manager, mostly of US growth funds, since July 2017. So, less than 10 years of experience as a PM. Not ideal, but he did also have more than 10 years of experience as an analyst before that, though. This is all according to Morningstar. Don't worry about what it says on the upper left, 12 years of industry experience. If you read the blip below that, you can clearly see that he's been an analyst since at least 2008, which is, by my count, much more than 12 years ago. All right. Jason has been in the industry and with Fidelity since 1991, so over 30 years. And he's been a portfolio manager since 2006, so nearly 20 years. It's also been pretty much all on US growth funds, so that's pretty good. Not that different. They actually manage on a few funds together, so let's look at how those have done. Fidelity Advisor Equity Growth, in blue, has been behind the Russell 1000 growth, in yellow, since Jason took over. That's the closest thing I could find here to its index, which is the Russell 3000 growth. This way, the Russell 3000 includes small caps, the Russell 1000 doesn't, but the two indexes are about 92 to 93% the same, so it's pretty close. It has slightly outpaced Fidelity Contrafund in purple, but remember, Fidelity Contrafund is not as growth-oriented, and growth has been heavily in favor for pretty much this entire time. It's been a similar pattern since Asher started on the fund in 2017. Same thing with Fidelity Growth Discovery, which they each started on a few months later. Honestly, I'm not sure what the differences even are between these two funds, but this is since Jason took over in 2007, behind the growth index, ahead of Contrafund. And this is since Asher started in 2017. Similar story. And those are the only two funds where Jason has a 10-year track record. And of course, Asher doesn't have a 10-year track record anywhere. Just to give you a sense of how massive of an advantage it's been over these timeframes to be more growth-oriented, here's the S&P 500 in orange since Jason started on his first fund. That's what Fidelity Contrafund is benchmarked to. It's dominated. These funds that Asher and Jason have managed on are benchmarked to an index that's closely represented by the yellow line. They have lost to that index. So, step 3, can the fund repeat its past success? Well, when it comes down to it, as long as Will Danoff is at the helm of Fidelity Contrafund, I feel pretty good about it. Even if Jason and Asher are managing 10% of the assets now, that doesn't really change much for me. But I think that he, Will Danoff, is an extraordinarily talented portfolio manager, one of very few that can consistently beat his benchmark. I'm not really convinced that Asher and Jason are. Even though the funds that they've managed have beaten Fidelity Contrafund, they're more growth-oriented, and growth has been heavily in favor. That's one of the things that influences results, but is not repeatable. Some people might say you just can't predict which style will be in favor going forward. Others, and I'm in this camp, would say that markets are cyclical, and actually, after a long run for growth stocks, it's actually more likely that at some point value stocks will come back into favor. Either way, to me, there's definitely no clear reason to have confidence that the growth orientation of these other funds will stay in favor, and we don't even know if Jason and Asher would manage Contrafund the same way as those funds if they did fully take over. What we do know is that they have not shown the ability to consistently beat their benchmark like Will Danoff has. And that, to me, would be enough to avoid this fund once Will Danoff retired. Given his age and the sign that he could be retiring soon with what looks to me like succession planning, I would personally prefer something that I felt had a little bit more longevity if I was looking for a new US equity fund. That said, if I already held Contrafund, I wouldn't be in any rush to sell it by any means, as long as Will Danoff is still at the helm. It will be something to monitor, though, for sure. Whether you're an owner, a prospective owner, or just simply somebody who's looking to learn more about how to evaluate mutual funds and ETFs, I hope you found this video helpful.